Gold isn't always going up. Sometimes the dollar is being repriced. And that repricing quietly rewrites what your paycheck buys and what your debts cost. And that isn't trivia. This plumbing leaks into your rates, wages, and savings. If you ignore it, you miss what hits your next paycheck before it's obvious. By the time it shows up in the news, your loan rate, rent, and groceries may have adjusted. Subscribe to Money Explained Money, Simplified. So here's the one question, no tips, no predictions, that makes the whole chart make sense. Gold's rise. Dollar's fear? Why do gold price today and silver price today trend at the same time? Most people answer fast. Inflation is up, so gold must rise. That story can be true, but it's often missing the mechanism underneath, because gold is priced in dollars, and the dollar has its own moving parts. Gold can react to rates, liquidity, and confidence all at once. So let's separate the stories that feel right from the ones markets price. First, those keywords spot and futures aren't the same thing. Spot is the cash price now. Futures are contracts priced for later. Futures can move on funding and expectations, not just physical demand. That's why gold futures spikes when rate headlines hit the tape. Example, one Fed sentence can move yields, and gold reacts before it's digested. So when you see a spike, ask, what changed in money's price, not metal supply? Here's a quick test. Did gold move, or did the discount rate move? Discount rate means the rate used to value future money in today's dollars. Now the biggest missing variable, the real interest rate. Real rate means interest after inflation, the true reward for holding cash. If real rates rise, gold faces a headwind because it doesn't pay interest. That's a basic incentive. Earn yield, or hold an asset with no yield. The Chicago Fed links gold pricing to long-term real rates and inflation. They show gold responds strongly to inflation expectations given real rates. So the driver is not inflation alone, it's inflation through the rate lens. That's why two identical CPI prints can still move gold opposite ways. Because markets price the path, not just today's number. Now add the second pipe. The dollar as the world's funding currency. The BIS documents dollar funding flows through non-US banks and borrowers. In stress, the world can face a dollar shortage in funding markets. Shortage here means dollars get expensive to borrow, not that dollars vanish. When that happens, behavior flips. People hoard dollars to settle obligations. That can push the dollar up and pressure commodities priced in dollars. So, why is gold down today? Can be a dollar squeeze, not a gold story. Here's the uncomfortable truth. Safe haven is not one single asset. Sometimes the haven is gold, sometimes it's dollars, sometimes it's T-bills. Which one wins depends on what the system rewards in that moment. And the reward is set by rates, collateral, and the need to settle debts. Want to see plumbing most people never hear about? It's in short-term money markets that keep big finance functioning daily. One example is repo. Short-term borrowing using bonds as collateral. Repo is like pawning a treasury for cash, then buying it back tomorrow. If that pawn shop closes, even for hours, everyone scrambles for cash at once. That scramble can push prices down across the board, even for safe assets. If repo strains, funding gets costly and some players must unwind fast. That can trigger selling that looks irrational, but it's mechanical. It can hit gold too, not because gold failed, but because cash is demanded. So price can move for plumbing reasons before any story catches up. Now zoom out. Why does a stronger dollar matter beyond markets? The IMF finds a 10% dollar rise can cut EM output about 1.9% after a year. They find the drag can persist for roughly 2.5 years in analysis. That's a second-order effect. FX stress turns into real economy tightening. And that tightening feeds back into hedging, risk appetite, and pricing. So gold can move on system stress, even when gold news is quiet. Now layer in central banks. Because their incentives are different. They manage reserves for resilience and settlement, not quarterly performance. World Gold Council reports. Central banks bought 1,082 tons in 2022. They report another 1,037 tons in 2023, the second highest on record. That doesn't set the price daily, but it can reshape long-run demand. Yet short-run drops can still happen when real yields jump or dollars squeeze. That's why daily charts feel chaotic, even when the long story is steady. Now bring in silver, because it confuses people even more. Silver is a hybrid, part monetary metal, part industrial input. So it can fall on growth fear while gold holds up on trust demand. That's one reason silver crash can trend while gold looks calmer. Here's another twist. Silver can track factories while gold tracks funding. If you've noticed that divergence, comment the week you saw it. And if any term felt unclear, ask in the comments and we'll answer it. Hold this model in your head. It explains 90% of the confusion in real time. Now we build the visual anchor, the two pipes model. Pipe 1 is real rates, what the system pays you to hold dollars over time. Pipe 2 is dollar funding stress, how badly the system needs settlement cash. Put them on screen like gauges. Yield up, funding tight, trust under pressure. When Pipe 1 rises, gold often faces headwinds from higher opportunity cost. Opportunity cost means what you give up by not earning yield elsewhere. When Pipe 2 stresses, gold can rise as a trust hedge unless dollars spike first. That unless is key. In a scramble, dollars are demanded before hedges. So gold can dip early in a crisis, then rally later when fear changes shape. Does that explain why headlines feel contradictory week to week? Headlines pick one driver, but markets price multiple pipes simultaneously. Now connect this plumbing to everyday life, without giving advice. When the system reprices the dollar, it can also reprice borrowing costs. That filters into mortgages, credit cards, and business funding over time. Think of it like this. Higher real rates raise the rent on money itself. Not because of villains, because higher funding costs change what's viable. A higher real rate rewards waiting and punishes distant payoffs. Distant payoff means cash far in the future, like long projects and long loans. That's why tightening can pressure housing and risk assets via discounting. Discounting means valuing future cash less when the rate used is higher. And a stronger dollar can tighten conditions abroad where debts are dollar-linked. This is why gold price in India spikes alongside U.S. headlines in search. Local gold prices mix global dollars with local FX moves and local premiums. So the same global move can feel bigger or smaller depending on currency swings. Here's the reframe. Gold isn't just a chart, it's a system stress signal. It reflects how the system prices time, trust, and settlement in dollars. When gold moves, ask which pipe is driving it, rates or funding stress. And the next deeper layer isn't gold at all, it's collateral and who controls it. Because collateral decides who gets liquidity first when the system panics. So here's the open loop. Who writes the rules for that collateral and why?